All right, let's talk robotics. You've got two companies making some serious waves, Knightscope and SERV Robotics. But here's the real question. When you look at the financials, who's actually got the stronger backbone? We're going to put them head-to-head, break down the numbers, and see who's really built for the long haul. Let's dive in.
So yeah, think of this as our tail of the tape. In one corner, you've got Knightscope, trading under the ticker KSCP, and in the other corner, SERV Robotics, ticker SRV. These are two companies with, let's just say, very different game plans for the future of automation. We're going to put their financials under a microscope to see who's really standing on solid ground.
So here's how we're going to break it down. Think of it as a 5-round fight. First up, we'll look at the big picture, just their sheer scale. Then we'll get into a balance sheet battle over debt. After that, it's all about performance and profitability. Then, a really interesting one, who actually owns these companies? And we'll wrap it all up with the final scorecard.
Okay, let's kick things off. Round one, the big picture. Before we get into all the nitty-gritty details, we have to start with the most basic question of all. Just how big are these two companies? And let me tell you, the answer shows a massive difference in scale.
And wow, okay, the contrast is immediate and pretty stark. Just take a look at the market capitalization. Knightscope is valued right now at about $69 million. SERV Robotics, a staggering $1.17 billion, with a B. So right out of the gate, it's clear the market is placing a much bigger bet on SERV.
And that huge difference in valuation? Well, it's reflected right here in their total assets. SERV Robotics just flat out has a larger asset base, which, at least on paper, gives it a much stronger foundation to build on. So for round one, based purely on size, SERV Robotics takes it, no question.
But hang on, size isn't the whole story, right? Not by a long shot. Sometimes a bigger company can just mean bigger problems down the line. So that leads us to our next crucial question. How financially sound are they really? It's time to pop the hood.
Welcome to round two, the balance sheet battle. This is where we're really digging in and looking at the nuts and bolts of debt and liabilities. This is how we find out who has a rock-solid financial structure and who might be getting weighed down.
The story here is just crystal clear. Knightscope is carrying a much heavier burden, pretty much across the board. We're talking higher debt, higher short-term and long-term liabilities. SERV Robotics, on the other hand, just has a much cleaner balance sheet, so when it comes to financial health, this round goes to SERV, hands down.
So let's just take a quick inventory. So far, it seems like SERV is running away with this thing. It's bigger, it has less debt, it seems like an open and shut case. But does that automatically translate into a better business day-to-day? Who's actually running a tighter ship here?
And that question leads us right into round three, performance and profitability. This is where we gauge that operational efficiency. We're moving past just size and debt to see how well these companies are actually, performing.
Okay, now this is where the story gets really interesting. First thing you'll notice is that both companies are operating at a loss. That's pretty common for young tech companies, so no huge surprise there. But look closer. Knightscope's operating loss is about $27 million. SERV's is nearly $60 million. So, relatively speaking, Knightscope is burning through less cash to run its business.
And we see this exact same story when we look at EBITDA. Now that's just a way to measure a company's core profitability before you factor in all the accounting and financing stuff. And again, Knightscope's negative number is smaller. This suggests they're doing a better job managing their day-to-day costs, and that's a definite check in their column.
So here's the trade-off. On the one hand, Knightscope is generating more revenue for every share that's out there. That's a good thing. But it's also spending more to get there. SERV is the complete mirror image. Less revenue per share, but it's also being more disciplined on its capital spending. This round isn't so clear-cut. It's a story of two very different strategies. So we have these two really different financial pictures taking shape. One is this massive company with less debt. The other is smaller, but in some ways more efficient. This all leads to a really important question. Who is actually in the driver's seat at these companies? Which brings us to round four, the ownership angle. See, it's not always just about the numbers on the page. It's about who holds the stock. That can tell you a whole lot about a company's strategy and who has the real power to make the big calls.
Before we look at the charts, let's quickly define a key term here, free float. It sounds technical, but it's really simple. It's just the percentage of a company's stock that you and I can go out and buy on the open market. A high free float means ownership is really spread out. A low one means insiders have a lot of control.
Now take a look at Knightscope.
It has a massive 99.95% free float. That is just huge. It means that pretty much every single share is available for public trading. Ownership is extremely spread out, with insiders holding next to nothing.
Now, contrast that with SERV Robotics. It's a completely different picture. Here, almost a quarter of the shares, 23.45%, are closely held. This means that insiders, founders, or large institutions have a much more significant, concentrated stake in the company. That gives them a lot more say over where it's headed. Okay, we've made it through all 4 rounds. We've covered scale, debt, performance, and ownership. Now it's time for the conclusion. Let's put it all together and check out the final scorecard.
This table really sums it all up, doesn't it? SERV Robotics clearly wins on scale and having a healthier balance sheet, but then Knightscope comes back and takes the points for performance with higher revenue and better efficiency on its losses. And ownership? Well, that's really a matter of preference. Do you prefer Knightscope's widespread public ownership or SERV's more concentrated insider control?
So, after all that, it really just boils down to this single trade-off. We're looking at 2 fundamentally different propositions here. One offers you that massive scale and a clean bill of health financially. The other brings you greater operational efficiency, just on a smaller scale.
This really just highlights the 2 completely different paths these companies are on. With Knightscope, you get a story about revenue efficiency, but it's a story that's also burdened by a lot of debt. With SERV Robotics, you get that incredible scale and a clean balance sheet, but you have to be okay with some pretty big operational losses for now.
And that is the real takeaway here. The goal wasn't to declare one of them the winner. It was to show you that these are 2 completely different financial bets on the future of robotics, and each one comes with its own very unique set of strengths and risks.
So I'll just leave you with this question to think about. When it comes to the future of robotics, where do you place your bet? Do you go with the company that has the bigger scale and stronger foundation, or the one that's showing better operational efficiency today? Which financial story makes more sense to you?